So we'll hit record and we'll get this going. I am going to talk about something a little bit odd today. I've been coming across a lot of people who they've taken a lot of education. They have learned a lot about real estate investing or investing in general. And when I talk with them, I keep assuming people know certain things, and most people don't. And my wife and I consistently have a conversation about common sense. And the most famous thing that we say all the time is common sense isn't very common. We have to learn common sense. Common sense for me is very different than common sense for my 10-year-old right now. Okay. We learn common sense. Common sense is not, you don't automatically learn it in a lifetime. You have to experience life in certain ways. So what I think is common sense with real estate, or kind of a base understanding, I've realized that's not a base understanding for a lot of people. I spend all my time thinking about this stuff, and most people don't. So that's normal. That's okay. But I realized I want to talk about a couple of concepts that make a lot of sense to me. But I've put together a spreadsheet for those of you who love spreadsheets. I put together a spreadsheet for today. If you don't love spreadsheets, it's really easy just to prove a point. It's a very simple concept, so don't worry about that. And what we're going to be doing is talking about one really basic concept, maybe kind of two basic concepts for real estate and investing in general that we need to understand. I'm going to share something. I've been reading a book. I'm going to show you here. It's called Family Fortunes. It's written by Bonner and Bonner, Bill and Will Bonner. They are a father and son team. Bill, the older of the Bonners, is somebody who's made hundreds of millions of dollars. And then he's done a lot of research, because what he wanted to keep money, not just make it. He wanted to keep it. And research shows that 90% of families that create wealth, that it's gone by the third generation, completely disappears by the third generation. So his concept is, how do we keep this wealth? How do we grow it, and how do we keep it? And he gives a lot of examples in different ways, a lot of tax strategies, interesting stuff for me because of how I'm geared and how I will talk to you guys here today. But here's what I want to do. I want to talk about the biggest negatives or the biggest problems with real estate investing, and what I believe is maybe something that it does better than any other investment vehicle. Okay. And then I'll share a little bit of human psychology. I've got a list of 3 things that came from this book that I'm reading that I agree completely with. And I'm just going to reinforce those 3 things at the end. And those are 3 tips of things to never do when you're investing. Okay. 3 things to never do when you're investing. So I've taken them right from the book, but I agree with them completely. A lot of the ideas that I'm going to be sharing are spawned from the book, but I'm going to be presenting them in a different way, or giving my own spin to them like I usually do. Okay. So number 1, real estate has 2 major flaws. And I want to make this a little interactive. So feel free to type in the chat or to put in the question and answer box or whatever. What do you believe are the 2 major flaws of real estate investing? The 2 biggest flaws. I'm going to be completely honest here. Okay. I'm biased because I love real estate. So I want to be really honest with the biggest flaws in real estate. What are the biggest flaws in real estate? Mark. I agree. I'm going to let a few people put in their answers before I weigh in on this. What are the biggest problems with real estate? Okay, so yeah, basically you guys have put in all the things. Okay. Here's my opinion, and a few of you have put some other ideas here, but here's my opinion. The biggest problems with real estate are twofold. 1, it's illiquid. You can't move money in and out of real estate really fast. That's how people have talked about real estate forever. Okay, it's illiquid. That's the number 1 reason why somebody who's convincing you to invest in stocks will talk about real estate. The first thing they'll say is real estate is illiquid. If you need to pull it out, you're going to have a problem if you need it quick. The second problem with real estate is that it is slow. It takes too long. It's slow. And I would add, I don't hear this very often, but I would add it's boring. Real estate investing is boring. At least the best real estate investing is boring. It's deals that take a really long time. You can't take your money out. That's the big problem, okay? Now, why is that a problem? Again, if you need money quickly, I was just talking with my parents about this yesterday. They said, Mark, listen, we're getting to an age where we need to potentially take money out quickly if somebody passes or something else is going on. Now, there are ways to take care of that I'll talk about, but those are the two biggest problems consistently that I hear. Now, someone said appreciation is a big problem. Somebody said shifty partners. Yeah, I would say appreciation. A lot of people talk about how real estate appreciates slowly. I guess that could be a problem in some ways. When you actually compare it to everything else, it's not really doing that. But again, I'll get into that a little bit. And then shifty partners, I agree completely. And shifty partners exist in every realm. Okay, so for example, investing in a mutual fund to me is investing with potentially a shifty partner. But with real estate, often because the deals are kind of smaller or they're done between groups of people, I agree, you need to have good partners, okay? But the big two are it's a liquid and it's slow and boring, okay? It also has a phenomenal strength. And this is a strength that I mean, the batch of people on here is pretty clever, so I don't want to be degrading or demeaning or anything, but it's something that most people don't think about. When they think about what's great about real estate, they don't think about this. This is my opinion. In my opinion, real estate is the best tax deferral program on the planet. I'm going to repeat that, okay? This is maybe what it does better than any other asset class. It is the best tax deferral program on the planet. It doesn't mean that you're avoiding taxes, doesn't mean that you are not paying them eventually. Governments are really well set up to make sure you still pay them, but it is a tax deferral program, okay? I'm going to share my screen about a chart that I put together just to show you an example of what I'm talking about, okay? So what I've got here, at the top, you've got starting capital of $100,000, and I've got 3 strategies, okay? And I'll talk about those 3 strategies in a minute. And then I've gone down 50 years, okay? Over 50 years, what the difference is. I'll explain these three strategies. Strategy number 1 is you set it and forget it. You put money into an investment. By the way, this is not simply real estate. This is any asset class, okay? If you put money into something and you don't take it out, in a lot of asset classes, maybe not everyone, and you don't take it out, you don't have to pay tax. You don't pay tax until you gain income from something. That's the way taxes are set up. Now, there are also inheritance taxes, okay? So even though you didn't earn your parents' money, if they pass on, you kind of make that money. That's the way government thinks about it. So you have to pay taxes there. But generally speaking, you pay taxes on income, okay? So tax strategy number 1, or investing strategy number 1, is you don't ever take it out until 50 years later, okay? You don't take it out for 50 years. Tax strategy number 2 is you invest for 5-year periods of time. So every 5 years you pull something out. This is really normal in real estate. Usually there are longer time frames rather than every year. And strategy number 3 is the strategy that would apply to most investing, and that is you are taxed on the gains every year. So for example, people who day trade in the stock market, people who even if it's not day trading, even if it's longer term trades, but they cash out on a consistent basis, people who are in and out of various investments over time, on a yearly basis, on the gains, they have to pay taxes, period. Now, it depends on what's happening. I have measured this as if you are getting capital gains, okay? You're claiming capital gains, which means the taxes are lower, okay? By the way, if there's any concept, I'm just gonna make sure, I'm gonna bring up the chat box. If there's any concept that I mention that is not really clear, most of the people on this call, I believe, are gonna understand far more than this, okay? But just in case I'm losing somebody, I don't wanna do that. So 3 strategies: you never take money out, you take money out every 5 years, or you take money out, you're trading. So you take money out every year, okay? Now, if you are practicing a strategy where it is legitimately your income, so sometimes getting into day trading, sometimes getting into flipping for real estate, now often the government can claim it is your income and you don't get capital gains from it, okay? So you got to be careful with this. But strategy number 1, number 2, number 3. Now here's another thing. I have put in compounding interest of 10%, okay? So it's a decent rate of return, 10% rate of return. What happens to your money after 50 years? I just want you to think about that for a second. They're all taxed the same rate. The only difference is that this one is taxed once at the end. This one is taxed every 5 years. Strategy number 3 is taxed every year. What happens at the end? Well, if you follow down to the end of the chart, in strategy number 1, it looks great. You're almost at $12 million by year 50, but after tax, you're only sitting at 8.8 million, okay? You've gained 8.7 million in this strategy. In strategy number 2, if you're taxed every 5 years, you're left with 4.3 million. If you're taxed every year, you're left with 3.7 million. Now that's significant. That is very significant. And it compounds over time. If you did it after the first year, it's not a big deal, right? Or sorry, after the first 2 years, it's not going to be a big deal. Even after the first 5 years, if you compare strategy number 3 and 2, strategy number 2, it had 161, strategy number 3 had 146 in it, or 147. And you were really sitting, it was only a $2,000 gap, $2,000 gap after the first 5 years. But you start going down long term. The longer term you think, the better the strategy works of not paying taxes on a consistent basis, but waiting to the end, the tax deferral strategy. And this is the idea behind RRSPs, right? The problem with RRSPs is most people don't get a very good return. So they don't grow it fast enough. The second problem with RRSPs is it's built for people who are planning to retire poor. It's built for people who are planning to retire with less money every year than what they are earning right now. So I'm going to shut this down and pull a couple of concepts out of here, okay? Oh yeah, so so Hong asked, can you clarify strategy number 2? If you refinance, there's no tax. Now, this is a tricky area again. Depends on your accountant, depends on what people are comfortable with. If you are refinancing and pulling money out, there are certain things you can do with the money and certain things you cannot do with the money, okay? Under new tax laws in the last 10 or 15 years. In that, in real estate, if you are pulling out money for income, then you will be taxed. If you're pulling out money to spend, you can be taxed. Now, there's a way around this in real estate, okay? And this is why it's the best tax strategy ever. This is also answering the question of, is it illiquid? Can you pull money out? Well, the quick answer is yes, you can pull out all your, you know what, I'm going to go back to the spreadsheet, sorry. Oh, I shut it down, didn't I? Okay, give me a second. I will pull it up again. One thing I love about real estate is that you can pull money out, and you can pull money out for things that you want to purchase, even if it has nothing to do with investing. You can pull money out to purchase things, and when you purchase those things, you don't have to pay taxes. It's amazing what you can do with real estate. I'm going to give you a really quick example, okay? Now, refinancing, I'm going to give you my opinion on this. I'm not a tax expert. I'm not a lawyer. I'm an investor that is really fascinated with these things, okay? And here is my opinion from talking to a lot of professionals and doing my own research. My opinion is that if you refinance, you're getting into a tricky area. When you refinance, you're getting into a tricky area because the government has an ability to argue that you are claiming some income. You're claiming some income. There's another way that that within the tax system right now, they won't do that, from my understanding, okay? And that is, let's look at this, okay? Let's say year 10, okay? So year 10, you've got $250,000 okay, $200,000 to $250,000 in your income. Let's use this, okay? So you're leaving your money and you're not pulling it out, okay? So you've more than doubled your money by year 10, and you want to pull some of this money out, but people say real estate is illiquid. Well, you can refinance. That's completely fine. You can do it. And again, most people are comfortable with this. In most situations, you won't be paying taxes, especially if you're reinvesting or doing something like that. But there's a really easy way to do this where you don't have to, if you refinance, you have to pay interest on that new loan that you've taken out. A far easier way that makes real estate very liquid, at least most of your real estate very liquid, is called a Heloc, home equity line of credit. Or you can have you can do this on other properties. You can have a line of credit that is guaranteed by or protected by your investment. So you go to the bank, you say, hey, listen, I want a line of credit. They say, well, we don't want to give you a line of credit for $100,000. It's too much money. And you say, well, listen, if I don't pay it back, you can take the property that I have, the house, the apartment building, the commercial real estate, whatever it is, okay? And so now you can have access to the money. Now, the beauty of a line of credit is that you don't have to take it out. You could leave the full 260 in there, okay? But if you do take out $1 or $10 or $100,000, that's when you start paying the rate, the interest rate that you've committed to the bank. So this is something that I really like about lines of credit, okay? The other thing that I really like about this is that you can pull it out for whatever you want, and it's extremely liquid. It's extremely liquid. In fact, it is far more liquid than most other strategies that people are using. Often, unless you've got your own brokerage or you're doing, again, day trading, something like that, where you've got strategies to pull money in and out very quickly, unless you're doing that, well, even doing that, money is not as easy as we think sometimes to pull it out. Even if it just takes a day or two, it can take some time. With a line of credit in a major bank or with major lenders, you can often access that line of credit in seconds. In seconds. So it's erased the illiquid problem, okay? We've kept the boring problem. We've kept the boring problem, but it's erased the liquid problem. And we've now done really well on taxes. Now, let me get into this a little bit more now. One thing I didn't put into that spreadsheet is fees. If you are paying fees, it eats away it eats away a crazy amount of our returns. So I've often spoken with people who are investing in the stock market. I've invested in the stock market as well, okay? I don't any longer, but I have in the past, and I did some research on the fees. The fees eat up a crazy amount of the returns you gain in stocks. So people often talk about, well, I gain 5% returns or 10% returns or 20% returns. Well, after taxes, even if it's capital gains, you're going to pay what, maybe 25% of those returns. So let's say you made 10% returns in the stock market. Well, 2.5%, that's 2.5% disappears, okay? And then if fees, depending on how often somebody's trading, the more trades, the more fees, all of a sudden that money disappears, and all of a sudden they're making 5 or 6%. People talk about 10 or 15%, but all of a sudden they're making far less, okay? So often, I love the quote by Mark Twain. He said, there are lies, there are damn lies, and then there are statistics. And what he was really saying there is that we can make statistics look the way we want to make them look. For example, if in my spreadsheet, I would have said you only have 5% compounding interest, well, it wouldn't have looked as drastic at the bottom. If I would have said 20% returns, it would have looked extreme at the bottom, okay? We can change stats in little ways to make it look better or worse. I chose a number at 10% because I thought, you know what, people should be getting at least 10% returns for their money, okay? The higher the returns, the more compounding interest, the higher the problem with taxes with this, okay? Now, in my opinion, real estate being not very liquid and being slow and boring is actually its greatest strength. Now, I'm coming at it from a psychological perspective, okay? From a psychology perspective, real estate is boring and illiquid, and that's fantastic. And this is why. Humans are geared for short short-term rewards. We are geared for short-term rewards. We take action based on what we can get in the next minute or the next day. Think about sexual relationships. Think about addictions. Think about, returns. Think about returns in general and what people get excited about. I'm going to tell you a quick story. For those who don't know about the Tulip Crisis or the tulip bubble in Holland in the 18th century, what happened was tulips, they found tulips in Turkey, and they went, wow, these are amazing. And the Dutch people started, at the time, the Dutch market was one of the strongest markets on the planet, okay? And so they had a really robust futures market. They started futures markets with tulips, so you could buy a tulip and on futures prices or sell it on futures prices. And what happened was tulips started going crazy. There was an extreme inflation of tulip prices. Now, because of this, it started getting expensive to buy tulips. It was a common thing near the end of the tulip bubble. It was a common thing for somebody to buy one tulip. They had to finance their entire property. It cost the equivalent of one house to buy a tulip. Now, it eventually crashed. People lost their shirts. A lot of people lost. Very few people did well in there. The people who do consistently well in markets like that are the people who are brokering deals. Why? Because they make money on the buy. They make money on the sell. They have little fees on both sides, and they're not in the deal themselves. So it doesn't matter whether the market's doing this or this. They make money either way. Okay, those are the people who do really well. In the gold rushes, the people who did the best were not the people, generally speaking, that were mining. Most of them died destitute or went away from the field destitute. The people who did extremely well were the people in the back end selling pickaxes, selling shovels, selling places to sleep or eat. Those people that were the service industry, they tended to do the best. There are great stories of people who did extremely well because they simply looked for the next opportunity and became the support industry. They didn't need to make the gold. They were supporting it. They're the people that typically do best. If you think about Wall Street makes its money not by investing primarily. Wall Street makes its money on the fees for investing, on making the trades, okay? Excuse me, I'm gonna sneeze here. Oh, maybe not. Okay, so psychology, we're wired for short-term thinking. And think about this. Think about 10,000 years ago. Well, it's far more than that. Let's think maybe 20 or 30,000 years ago. Okay, so there are a lot of nomadic people groups, and we're traveling in small groups. What mattered most was not that we're taking care of our retirement. That was not what we were taking care of. What we were focused on most was what are the berries and the meat and the food that we can find around us to survive for today, to survive for this week. Humans have been geared towards short-term thinking throughout our entire history. It's very, very, very odd, and it's a very short-term thing that humans are thinking about retirement, that people are thinking about like money for retirement, okay? The strategy up until the last 50 to 100 years was have 10 kids. If you have 10 kids and only 3 or 4 of them die, now you're left with 6 or 7. That's your retirement strategy. When you're too old, you got 6 or 7 kids to take care of you. That was the retirement strategy, okay? To think about money with retirement is a very new concept. So what I'm basically saying is that humans haven't evolved to have long-term thinking. It's very strange. And I'll give you a couple of examples. Elon Musk has a strategy to populate Mars. Okay? His thinking is hundreds of years, not within his lifetime. Japanese companies are famous. There are some Japanese companies that have 2 or 250-year strategies. That's crazy talk. Okay, and my guess is that even when you hear that, you're like, that's crazy. Why do we plan for like 4 or 5 or 6 generations after us? What sense does that make? Well, again, a lot of these concepts are coming from Family Fortunes, and I've really enjoyed the read because it's thinking long term. What the authors say consistently is that people who think long term do better overall. That the short-term thinkers that are getting caught up in the sexy deals, not things that are boring, things that are exciting, tend to do worse. taxes eat away, fees eat away, and we make poorer decisions because it's less based on logic and more based, our decisions are typically more based on emotion in the moment, okay? What else do I want to say about this? Oh yeah, so I talked about the tulip mania, the stock market right now. The stock market is if you look historically, the stock market has done extremely well. Here's the difficulty. The stock market's producing less yields than it has ever done in the past, meaning you get less returns for your money. The way that people are making money in the stock market is by this happening, not by the dividend payments. Okay, the yield that they're receiving on a consistent basis. Why is this a problem? Because with the market, when the market does this, most people, there are a few sophisticated investors that understand what's going on and plan for it. Most people lose their shirt. And by most, it's the vast majority. It's something like 97, 98% of people in stocks lose a crazy amount when the market goes down, okay? So, I mean, people talk about hedging, but they're not making money in those times. They're still losing money in those times, generally speaking, okay? Think about Calgary. So I come from Calgary. In the mid 2000s, 2004, 5, 6, 7, the market was rising 20, 30, 40%. Everyone was excited. Everyone lost their mind. Short-term thinking went, in Calgary, it'll never go down again. It's just too good a market. Oil is doing well, and this is doing well, and that's doing, looking in hindsight, you're like, what? But we saw these things, most people saw these things and went, you can't lose in real estate in Calgary. You cannot lose. You buy it and you wait, you will make money. That's thinking of, that's again, the hope and pray strategy, right? That I hope and pray it goes up because if it goes down, I lose my shirt. In Toronto right now, in Ontario right now, the market's going nuts. Now I'll give you another, you know what, I want to share another sheet here. I'm just doing some more research because this is something. Oh no, this is the consumer price index. Never mind. I'll show that in a little bit, okay? Because inflation also eats our money, right? But in Ontario, if you do research on Ontario, people, when I hear people talk about Toronto especially, they're like, Toronto will never go down. We've got such strong in-migration, all these positives. We may never go down again. We will just continue going up. Maybe not at the pace, but we'll continue to go up. And I go, read history. Well, look at history. In 1989, there was a high in the Toronto real estate market. Then Toronto took a huge dip, and it took 13 years before it even reached the levels that it was before. That's without making any appreciative gain. It just took 13 years to match where it was before, 2002. Don't trust me with this. Do your own research. 1989 to 2002, 13 years, Toronto real estate didn't make a penny, okay, through appreciation. But again, we get excited about these things. So I'm not saying the Toronto market's going to fall tomorrow. I don't know when it's going to fall. Is it going to fall? Well, if history is correct, every market falls, every market. Okay, there's never been one market on the planet that hasn't fallen, period, over a long period of time. Okay, and again, if you have a challenge to this, feel free to let me know. Okay, if you know of some investment opportunity that has never gone down, please let me know, because it'll be new to all of us, I'm sure, or at least most of us. And think about people who do better with real estate or with investing in general. Warren Buffett. Think about one of the best investors of all time. His strategy is that he never sells anything. That's his strategy. This is coming back to everything that I've been saying, right? Long-term strategy. Don't sell. Have a long-term. He doesn't sell things. He just buys them. He's got another strategy, and that is every dividend check that he receives from any company that he's purchased, he buys more with. It's compounding, okay? So if you have a strategy, this is actually why my partner and I put together our limited partnership agreement the way we did, because it pays out. Instead of paying a return, it pays out your original capital, which means you can reinvest it and you start compounding your money far faster. So again, we have to understand these things. Okay. Yeah, so a key concept in this book is that long-term thinking wins the day. Long-term thinking, delayed gratification. Every time a market rises, people look like geniuses, whether it's real estate or stocks or gold or whatever. Everyone looks like a genius. Every time it falls, most people look like complete fools. Most people look like complete fools. And then usually people blame real estate or blame stocks or blame whatever. It's not the market's problem. It's our problem. We need to think better. Those who have a consistent strategy tend to win long term. Okay, 3 things. I promised that you guys, and it's coming up on the half hour here, so I want to get going. But some things not to do in creating wealth or creating a fortune. This is consistent advice that comes from wealthy people. 3 things is never invest in anything you see advertised. Never invest in anything you see advertised. Why? Because if you see something advertised, it's being marketed for the foolish or the uneducated. If something is a truly great opportunity, the people who are in the know take advantage of the opportunity. Okay? Great investments are made typically with a small group of people. You need to know somebody. You need to be networked with somebody. Those are typically the best investments. The thing that's mass marketed is mass marketed for a reason. It's marketed to those who are ignorant, who don't know how to get the best deals. Okay. Secondly, and this is from the book, not from me, although I agree with it completely. Secondly, never put your money into anything you see on TV unless it's presented in a negative light. Or basically what he says is if it's talked about in the media, never invest in it. Because the media is a lagging indicator of what's doing well or doing poorly. The media, general media, doesn't know that 2008 is coming in the stock market. The media doesn't know when things are happening. They simply state what people are excited about. So it's the same kind of idea. I think, who is it? Somebody said, when you start hearing like the post person and the person in the grocery store and the person who shouldn't have any knowledge of the stock market or real estate markets, when you hear them talking about how excited they are about stocks or real estate, it's time to be terrified. Why? Because the trend is now doing this. Okay, not even this. It's doing this. It's doing this, and it's about to take a dip. So one thing Roy is asking is, so what if you have smaller amounts of money, let's say less than 10,000 or even 5,000, what sorts of investments would be the thing to invest your funds in over the shorter term? I'm going to answer that question in a second. Okay. I'm going to share the 3rd thing to never do. Do not invest in anything. Now, this was his words. Do not invest in anything that everyone considers safe or conservative, because the returns are so low, generally speaking. He's got some other answers to this, but returns are so low that you're not even beating inflation. So I'm going to share the inflation chart really quickly with you, and then we will, oh, did I disappear that too? Okay, hold on a sec. I'll get to the inflation chart. So people, I was talking to just somebody yesterday who is an investor, who is really, really well educated when it comes to this stuff. And I said, well, this needs to be tied to inflation. And he said, oh, so like maybe 2%. I said, have you paid attention to inflation? People say it may be coming. It's here. It's here. This is taken from Stats Canada. This is not somebody who's blogging and trying to convince you of something. This is Stats Canada. The consumer price index rose 4.4% on a year-over-year basis in September. Okay. So compared to September of a year ago, it's risen 4.4%. The fastest pace since February 2003. Excluding gasoline, it rose 3.5%. Now the CPI, a lot of people complain about the CPI, saying that it is a terrible way to measure this because it doesn't include the housing market. It doesn't include gas. It doesn't include some other things at times. Okay, and so we go, well, we've got to be careful with what we put in it or what we take out of it. But generally speaking, even governments are acknowledging, listen, the inflation rate is really high. So if it's 4.4% and it's going higher right now, if it's at 4.4%, let's say 5%, just to be simple. Okay, if it's at 5%, and taxes eat away a quarter of what you're making, and you have fees on top of it, how much do you need to make? How much money do you need to make? Returns do you need to make to actually break even? If you make 10% returns and a quarter of it is taken away from tax and half of it is taken away from inflation, you're left with 2.5%. If fees eat another 2%, which is very common in the market, mutual funds, very common to take more than 2%. Well, now you've been left with nothing. You work really hard to end up with nothing. Okay, I'm going to answer this question that Roy asked. So what do you do if you're the average Joe Blow? What if you only have $10,000 or $5,000 to invest? I don't have a simple answer for you. I don't have a simple answer. It is very, very difficult to make really good, consistent, long-term returns if you only have $5,000 or $10,000. In my experience, and again, I'm free to challenge. You guys know that I'm free to be challenged on this stuff. For me and my understanding, the problem with $5,000 or $10,000 is that most people who have $5,000 or $10,000 also don't have the education to be able to do something. So, for example, if Warren Buffett lost everything and he only had $10,000, well, with his connections and his ability to do well, his understanding of the markets, he can make money from $5,000 or $10,000, okay? Because he thinks in a different way. But the average person who has $5,000 or $10,000 doesn't have that kind of education. Fractional real estate investing help in that case. Yes, so there's something called fractional real estate investing. Exempt markets, dealers do this a lot. The problem is that if you're investing in a REIT, typically your returns are lower than what you could do with a partner or on your own, okay? So you're taking a cut in the percentage. Yes, you can still do it. You're taking a cut. And again, in a REIT, there are going to be fees. There are going to be a whole bunch of other things going on, okay? Yeah, so somebody says, Hong said, pay off your credit card or other debt. Absolutely. But if you've paid off those things, what do you do with $5,000 or $10,000? It's very difficult. For me, the cutoff is about $20,000. Once you have $20,000, you can start doing some interesting things, okay? And the fees don't eat enough to start making money on it. So what I would say for somebody brand new to this is I would say, start with $20,000, do whatever you can to make the $20,000, and then, nothing illegal, $20,000, and then invest for the long term. And don't touch it, don't think about it. Remember, human psychology is geared short term. So if we have a boring asset class like real estate, where it doesn't do anything exciting, so we forget about it, that's exactly what you want. That's exactly what you want. If you're tempted to take money out and do a bunch of crazy things with it, that's where you get into trouble. There was another thing that this guy said, and that was make bigger. If you're making massive decisions when it comes to real estate or something, make them slower. Okay, don't make 5 massive decisions every year with your finances. Make a massive decision every year, every 2 years, every 3 years, every 5 years, every 10 years. If you look at people with extreme amounts of wealth, they make their decisions every sometimes 10 or 20 years. They make a big decision. Otherwise, they make small decisions. Okay. Something that Sam said, and I agree with this as well, is invest in yourself. If you only have $5,000 or $10,000, I would give you 2 strategies. One is, if you understand a market or an asset class really well, then I would say go hard at saving it and get to that $20,000 mark. $20,000, $25,000. Now you can start investing it in some really unique ways. Okay. If you're below that and you don't have the education, get the education. Do whatever you need. I've paid probably $250,000 in my education. Every time when I started my business, every time I made a dollar, I would reinvest it in education. I used everything. Okay. We lived like paupers for a very long time because we reinvested everything into my education. And because of that, we can now do a whole bunch of crazy things with less money. We can do a whole bunch of crazy things. So I agree with that as well. Okay, we're way over our time here. Hopefully this is useful. Hopefully this is helpful. One place I'm going in my mind with all of this is that I want to start to produce a series. Actually, I'm going to tell you something that I haven't told anyone. I don't know if I've told anyone publicly this. I've been working with somebody, a former client of mine, on creating a program for parents and kids, a real estate financial education program for parents and kids. This is different than any other program we've seen out there. I've seen a couple books. We've seen other programs out there. This one is different, and I'm really excited about it. We're still a ways away from launching it, but if you guys are interested in that, let me know. yeah, if you've got questions about this, let me know. But I've been thinking about how do I educate people? How do I help people understand these concepts? The concept we talked about today is something that I don't see very often. People talk about all the ways you can make money in real estate, which is true. And I like that. I like that education. I like the Rich Dad education. You can see the books behind me, okay? Rich Dad, Poor Dad. I love that. But I think there's things that we're missing. And that is, how do we think? We need to think long term. And as we think long term, we will consistently do better. We will consistently outperform almost everyone who's thinking short term. There are very few people who think short term who do extremely well. Enjoy your weekend. Enjoy next week. We'll see you around.